You can pay your credit card bill by the due date and still see your credit score move in the wrong direction. One possible reason is credit utilization, a measurement that many consumers misunderstand. Credit utilization compares the revolving debt reported on your accounts with the credit limits available to you. Revolving credit includes accounts such as credit cards that allow you to borrow, repay, and borrow again up to a limit. The calculation is straightforward. Divide the reported balance by the credit limit and multiply by 100. If a card has a $1,000 limit and reports a $700 balance, its utilization is 70%. If you have several cards, scoring models may consider both the utilization on individual accounts and your overall utilization across those accounts. Why does this matter? Credit scoring models try to estimate the likelihood that a borrower will repay as agreed. Being close to the limit can indicate financial pressure. That does not mean a high balance proves someone is irresponsible, and it does not mean every score will change by the same number of points. Different scoring models use credit report information differently, and the effect depends on the rest of the person's credit profile. You may have heard that utilization must stay below 30%. The Consumer Financial Protection Bureau describes 30% as a commonly recommended maximum, while some experts recommend lower utilization. But 30% is not a magical line where nothing matters below it and everything goes wrong above it. In general, lower reported utilization is better than higher utilization, as long as the account is managed responsibly. Here is where timing becomes important. Your current balance is not necessarily the balance appearing on your credit reports. Card issuers report account information periodically, commonly once per month and often around the end of a billing cycle. Reporting practices vary, so the balance used in a score may be the amount reported before your payment reaches the issuer. Imagine a card with a $1,000 limit. You spend $800 during the billing cycle. The issuer reports that balance, and you pay the statement in full by the due date. You may avoid purchase interest if your card offers a grace period and you meet its conditions, but the credit report could temporarily show 80% utilization. Paying in full is still excellent financial behavior. The timing simply explains why the score may reflect a high reported balance temporarily. One possible strategy is to make a payment before the statement closes or before the issuer's reporting date. If the balance falls from $800 to $100 before the issuer reports it, the reported utilization could fall from 80% to 10%. This does not guarantee a particular score increase, and consumers should not obsess over daily fluctuations. It can help when a low credit limit causes ordinary spending to produce a high reported percentage. Overall utilization matters too. Suppose you have two cards. The first has a $1,000 limit and a $900 balance. The second has a $9,000 limit and no balance. Your combined limits equal $10,000, so overall utilization is 9%. However, the first card is 90% utilized. A scoring model may consider both figures, which is why concentrating a balance on one account can matter even when overall utilization looks low. Another common mistake is carrying debt because you believe paying interest builds credit. It does not. You can use a card, allow account activity to be reported, and pay the statement balance in full. Carrying an interest-bearing balance is not required for a good credit score. Closing a card can also change utilization. Suppose your total credit limit across two cards is $10,000 and your reported balances total $2,000. Your overall utilization is 20%. If you close a card with a $5,000 limit while the balances remain unchanged, your available credit falls to $5,000 and utilization rises to 40%. The actual score effect may be small, temporary, or significant depending on the rest of your profile, so this does not mean a card should never be closed. An annual fee, overspending risk, or poor account terms may provide a valid reason. A credit limit increase can reduce utilization if spending stays the same, but approval is not guaranteed, and the issuer may review your income, payment history, or credit. A larger limit helps only when it does not encourage larger balances. The practical approach is simple. Pay every account on time, keep balances below the limits, consider an early payment when reported utilization is unusually high, and avoid borrowing solely to manipulate a score. Before applying for a major loan, review your credit reports and give lower balances time to be reported. The main takeaway is that utilization measures reported debt relative to available revolving credit. It is not a reason to carry interest-bearing debt, and it is only one part of a broader credit profile. This video is for informational and educational purposes only and is not financial, legal, or investment advice. Credit scoring results vary, so consider your circumstances and verify account reporting practices with your issuer.